Welcome to the August 2021 episode of the Accounting Working Group podcast, hosted by the Wall Street Blockchain Alliance. I'm your host and chair of the Accounting Working Group, Dr. Stein Smith, and I'm thrilled to have on the August episode right here, James Parillo, who is the GM of Figment Fund 1 LP. And that's could sound like the name of a movie or a transformer, but it's actually not. So I'm going to hand it over to James for a introduction of himself, his firm, and all of that good stuff. James.
Hi, Dr. Sean. How are you?
Good, excellent. How are you?
I'm doing well, thanks. So hi, my name is James Parillo. You may know me. So I just recently started as general manager of Figment Fund 1 LP. This is the inaugural fund that Figment Inc., the Figment team is launching. And you may have heard of Figment before. Figment is also Figment Inc. is a staking as a service provider that provides validator and staking services for over 40 networks that they promote. Additionally, Figment is so I kind of describe it as like a three-legged stool. So we've got Figment Inc. that's providing infrastructure. We have a group that Figment Inc. also performs education programs, developer documentation, and drives governance activity for community building. And then the third and most recent iteration and evolution of Figment is to provide capital investments into through our venture capital fund for networks that we are excited about and want to support. So that's what I'm doing today. In my past life, I was the national tax lead partner for KPMG's U.S. digital asset fund practice, and I've been providing tax compliance and tax consulting services for digital asset funds starting in 2017.
Wow. So it honestly sort of hits me that you are really a example of a individual who has a accounting tax background, who has been able to sort of transition now into a more active role, a hands-on role at a real asset manager crypto staking company. And if you could sort of build out on that for us, James, what is that crypto staking mean in terms of actually how it works and how it's different from other crypto options out there? And then are there any hot button issues, hot topics as it pertains from a crypto tax angle outside of the obvious ones?
Yeah, thanks. So staking as a service. So one other thing is just that I've been in the space since 2015. So I've been investing in cryptocurrency myself since 2015, and so it's been a really interesting ride from then, where it was Bitcoin, Ethereum, and like Litecoin that was available on Coinbase, to now where you see Coinbase, you see Coinbase Wallet, you see DeFi, really just eating up traditional finance. And one of the areas that's been very interesting, and there's a lot of cool stuff happening on, is the consensus models, and specifically proof of stake, which with the Ethereum 2 merge from ETH1 to ETH2, it's going to be moving from a proof of work consensus model to proof of stake. And so proof of stake at a high level allows for the security of the network to be in order to provide security to the network, token holders play a key component in that. And so whereas in proof of work, consensus was performed by miners, which we've probably read a ton about, that it's energy inefficient, it's a waste of energy. What proof of stake does is ultimately is a slightly more efficient, energy efficient way of coming to consensus that's still trustless and permissionless. And ultimately what it also does is allows stakeholders, like just like the name says, right, proof of stake, that you can stake your tokens, prove that you have a stake on the network, that you are going to lock those tokens up, which ultimately provides security for the network. And in exchange for that, you will earn rewards, similar to what mining rewards look like for miners, but it's it's run through a validator, and usually what happens is that there's a staking as a service provider like Figment that is going to run infrastructure, going to run validators, but it requires the need for tokens to be delegated or staked to its address. And so usually these validators will charge some percentage of a commission, anywhere from 0 to 10%, sometimes just higher. And in exchange for that, they're going to share in the staking rewards that they earn. And so someone like myself can stake either Polkadot or Ethereum 2 and earn some passive income for staking my tokens, for holding for hodling my tokens, for not being able to trade them, and in exchange for that, you get additional tokens, which is great. And it's a super interesting area, the IRS from a tax perspective. So then we talk about what are the hot button issues from a tax perspective, right? And there's, as you know, there's very little guidance out there when it comes to just cryptocurrency taxation in general, although obviously there's
wow. Oh, yeah. Oh, what shocking news to me, James. Whoa.
Oh, you're surprised. Okay.
Yeah.
No.
I'm shocked. You're stunned. Let me tell you. No, go ahead. I'm sorry.
Yeah, no. So it's wild. It's wild. It's been around for as long as it has, and the guidance is as thin as it is, right? And so the first guidance is, I'm sure your listeners know, came out in 2014. But it was really like a FAQ, and in reality, the IRS has issued maybe 3 items that have been guidance for taxpayers. It's all been focused on almost like individual retail taxpayers. And it's really kind of missed the mark on what some of the central issues are that people are struggling with, particularly as cryptocurrency becomes institutionalized and larger entities, including investment funds, begin to think about investing in cryptocurrency or are already investing in cryptocurrency. And so, the first guidance was that Bitcoin is property, and that was more or less, and that was more or less everything. I think maybe they mentioned that mining operations could be considered a business, operating like a trader business. So that's what we started with 2014. In 2019, there was another FAQ that came out, the guidance there was a little bit more complete, but ultimately was a little bit bungled as well. Airdrops were mentioned, hard forks were mentioned. They were sort of also linked together in some ways, which was very confusing for taxpayers. But that's really been proof of stake was maybe like a concept, or there were very few protocols that were on proof of stake at the time. And so staking is something that's become, it's going to become, especially when the second largest cryptocurrency converts from proof of work to proof of stake, it's going to be front and center. JP Morgan recently issued a report stating that it's going to be I think this is the point in time where crypto kind of goes mainstream, which is that you have traditionally investors, institutions that have had a hard time valuing tokens and having to figure out, how does this thing have value? What is this value? How do we ascribe value to it? And what staking rewards are going to do is it's going to create a passive income stream that can be modeled, can be evaluated. And I think it's going to be something that allows a lot of institutional investors something that they're used to seeing, and an ability to say, okay, I now understand that this is more like almost like how they can value bonds and yield. They'll be able to kind of model it and say, this is what we think is a good investment and we're going to invest in it. And so so there's that aspect. But from a tax perspective, there's zero guidance, right? So the questions that come up are, there's currently I'm kind of rambling a little bit, I apologize, but the history of taxation on staking is it's pretty new, right? There is no history. There's currently a case at the Supreme Court for that the Proof of Stake Alliance is I think at the forefront of asking whether or not staking income should be recognized at the time that it's earned, or when it's sold. And so without kind of going too deep into that, issue because like it's obviously still pending. There are people who think that that it is income, like that staking income is earned. So staking income is really interesting, right? It's not like you earn it like in real time. So sometimes you earn the tokens and you earn them on like a weekly basis. Sometimes it's accruing like by the second, and you can actually watch your your tokens like accrue and the amount that you can claim of rewards you can claim just accrue like by the second or by the block, right? And so it's super interesting. It's really kind of it's definitely passive income, and the questions around it are like, okay, so first off, I've already just mentioned timing, right? So the timing, when do you recognize it? Is it upon when you claim it? Is it, hey, it's already, I have control over it. I can see how much I whether I claim it or not, push the button. Maybe I already own it. Or is it something different where you know, it's like a piece of art or like a plant, a seed. I plant a seed in the ground, it grows a tree. The farmer doesn't, like when the farmer picks the apple, it doesn't recognize income. It's when it goes to the market and it sells the apple. And so that's sort of one of the arguments as well. It's like these assets come from nowhere, and all of a sudden you've created one for validating a block on the blockchain. And so how do you say that like you haven't earned anything? You've created this token out of thin air. So timing is one of the questions. The second question is going to be character, and the third question is sourcing.
Wow. So I would say that it's a pretty safe guess that there are some pretty nuanced tax questions out there, right, James?
Yeah, that's right. So we've got a lot of taxpayers out there, and like I said, I'm not trying to take a position one way or the other because I don't want to obviously do any influence. But some of my clients have taken there's like conservative approaches, right? And so the question becomes, when it comes to timing, is like, we've got some my clients are partnerships, right? And so if they get it wrong, then they may have to amend like years of returns. And so they've generally taken the position that like their accrual basis, they'll accrue the staking earnings as they go. And we're assuming that it's like, it seems a little bit like interest, smells like interest. There's like usually like, even if you go on websites, it says like it's APY, right? So like there's some component of like almost like FDAP, which is fixed, determinable, annual, and periodic. So because you can kind of model out and you kind of know what you're going to earn at the end of the year. That aspect of it is, but there's another question as to whether or not it's like active trader business income. So mining, for example, if you're mining is like an activity that people perform. And it's pretty well thought of as that like, hey, like you're mining the tokens, so the tokens are part of your business if you're a business of mining. When it comes to staking, it gets a little bit more nuanced and a little bit more complicated, because with delegated proof of stake, the validators don't actually take custody of the assets whatsoever. Jim Parillo staking with Figment Inc. Figment is running a validator. Jim Parillo's tokens, what I do is I wind up, I lock my tokens up, right? They can't be freely traded yet. Liquid staking is on the way. And what I do is I ultimately just vote and point my tokens that I hold in my wallet to Figment's validators. And so when my tokens are selected to validate a transaction or validate a block, it goes to me and I point it to Figment. And what that ultimately does is it creates a question as to like, okay, what type of income is this for me? I'm not actively doing anything. It doesn't seem like it's active trader business income. But number two, when the tokens are distributed from the network to the parties, the tokens the commission, if there is one, goes from the network to the validator. And my piece of those tokens does not go through the validator. It goes from the network to my account. And so now the question becomes, and I think one of the biggest question marks in the space is, where is this sourced? Is that income sourced to where the network is located? Because it's on the internet and it's decentralized. So it's everywhere and it's nowhere. Is that income sourced from the validator who has validated these transactions? Because there's a lot of questions about that. Or is it where the keys are located? Is it where I'm located? There's a lot of questions about it. And specifically sourcing is the one I think where we could really use the most guidance right now, which is like, how the heck do you source any of this stuff? Nobody really has any good answer right now.
Wow. I mean, so there's going to be plenty of, I'd say, good opportunities for some work, I'd say, going forward, in trying to answer, trying to advise internal colleagues and external clients on all of these issues. So with all of that sort of backdrop and the open items and sort of the nuanced nature, proof of stake, delegated proof of stake, and all the rest, has there been a uptick in the appetite from a institutional point of view, right? Because I know, as the two of us actually were chatting about earlier, there has been this overall sort of comment that the institutions are coming, institutions are coming, and it honestly seems like they're actually here now. So has there been a sort of correlation between the rise in interest from a institutional point of view and the continuing a rollout of these new options beyond proof of work?
I believe so. I think that the institutions are certainly on their way. During my time at KPMG, the last 8 months, or maybe even like 10 months, were busier than the last 3 years combined. With new funds launching, with new investment funds launching. It's been one of the most rewarding and exciting times for me, both professionally and specifically when it comes to cryptocurrency and blockchain. Just understand like that the institutions, maybe particularly, and maybe it has to do with decentralized finance as one. I think that they feel as though they're missing something, they missed out on something, or that there's still time, and that they're starting to see the value in how in these protocols, and that this is really the future. I think there's an acknowledgement that decentralized finance has changed the game a little bit, and kind of flipped it on its head, and that anybody can now participate in these in lending, in trading, in providing liquidity and liquidity provisioning, and that there's real opportunities out there. It's super exciting, and so we're seeing traditional investment managers ask more questions and schedule calls with us. Bitcoin, I think the other thing is that Bitcoin has sort of gone mainstream, right? I mean, with MicroStrategy, Michael Saylor just buying, I think it's July 30th. I don't know if that's okay to say or not, but like, I think Michael
it's fine, don't worry about it.
Okay. So like Michael Saylor said like yesterday that I think that he bought they just bought $55 million worth of Bitcoin. So they're gonna keep buying, right? I mean, and I think what it's done is, I think, even like it or dislike it, Tesla announcing that it was accepting Bitcoin. I think it started to become a conversation at board of directors meetings, and everyone was asking, what is our position on cryptocurrency? And that's a good conversation to have. I think that's a good thing that folks are starting to have that conversation. And it seems like now, or maybe very shortly in the future, once you get comfortable having Bitcoin on your balance sheet, hopefully the rules around valuation of it change here shortly for financial statement purposes. But once you get comfortable with Bitcoin, that's the rabbit hole, right, that we all hear about and talk about. And so hopefully what happens is they start to say, okay, well, what about Ethereum? And Ethereum has some, it's more than just smart money. It's got the ability to build applications and on top of it. And so I think that's where a lot of folks got really interested really quickly, and we're finally beginning to see the fruits of all those developers' labor over the last 4 or 5 years, where now there are real tangible products, NFTs, decentralized finance, social tokens are beginning to come across my screen more and more. DAOs, decentralized autonomous organizations are starting to launch, and so I think once people kind of go down that rabbit hole, they're really excited about what else cryptocurrency can do for their organizations, and I think we're going to see more adoption, not less.
Well, I think so too. And to round out our conversation here right now, is there anything else that you would want to tell the audience, either on the fund itself or the entity at large, right? Either the Figment Fund One or the parent institution, in terms of areas of interest, hot topics, or other items of that kind.
So we just recently announced, so Figment Inc. itself, we just recently announced a grant from the Graph Foundation. For the Graph has granted us perhaps the largest grant thus far of tokens at 80 million Graph tokens, in order to help continue to build the infrastructure that the Graph is, by doing. We're going to help build we're going to be one of the key developers of the Graph protocol, which is a indexer and allows for, essentially, the way they market themselves is they're going to be the Google of blockchain. So it's an incredibly exciting project. We're really excited about the partnership that we have with the Graph, and it's just another building block that Figment has, that Figment will be performing in order to support and continue to build our vision of what a world looks like under Web 3.0. But we're really excited. We're also in the venture capital fund is off to the races. We've made some investments that may not be public yet, but we're super excited about the opportunities and the teams that we are partnering with. And please feel free to reach out to me if you're developing a protocol, or if you're interested in developing, or how I got what I'm thinking about, what I'm focusing on. Like, you can find me on LinkedIn, you can find me on Twitter at Velvet Milkman, and I'm all over the place. So feel free to reach out.
Awesome. And Jim, one last question that I had not prepped you for. So, and I'm trying to ask every guest this actual question. What is your year-end 2021 price target for Bitcoin?
So, a funny story. I presented to the KPMG Asset Management Tax Group back in February, and I said, like, hey, here's an opportunity. Here's what I've been doing for the last few months. Like, it's been like a geyser of activity and of new launches. And I said that we will be looking at $100,000 Bitcoin by September. And I said, like, just remember this conversation. It looked like we were going to hit it. Like we thought we were going to hit it. Like, at one point in like April, I thought we were going to hit it like tomorrow. You know what I mean? But I'm and there's been a lot of calls for 300,000. I don't know if it gets there, but I do think, I hope it hits by year end, probably right before tax season. I think July was a difficult month. I think that August, September is usually historically pretty good to Bitcoin. I'm going to go with $105,000.
$105,000 year-end price target for Bitcoin. You heard it here first. Jim, it was a pleasure having you on the podcast. I mean, there is so much to talk about from a tax ecosystem development point of view that we are going to absolutely have to have you back on the podcast. Thank you.
Thank you, Dr. Sean, and the Wall Street Blockchain Alliance is a great group. So I sincerely hope that everybody has following you guys, and you guys are we are at the forefront of a lot of these issues, and it's been really great to work with you and partner with you. Thank you for having me.
All right, Jim, thank you so much again.